Welcome back to my channel, MB Capital Strategies. Welcome back to the mining series part 3. Today we're talking about the stock Yancoal Australia, a name that many retail investors don't even have on their radar, but the facts speak for themselves. We have a double-digit dividend yield, over 80% upside potential according to DCF models, and a balance sheet that's stronger than some blue chips. But how does Yancoal make its money? And how sustainable are the payouts? And why could this Australian coal company benefit from the next commodity supercycle in 2026? And that's exactly what today's video is about. Welcome to part 3 of the MB Capital Mining series. Let's get a brief overview and take a look at the business model. Yancoal Australia is one of the largest independent coal producers in Australia. The company operates several mines in New South Wales, Queensland, and Western Australia, producing both thermal coal for power generation and metallurgical coal for the steel industry. The main customers here are China, Japan, South Korea, and India. What's special, Yancoal was originally founded as a joint venture with Yanzhou Coal Mining China. Today, the Chinese state-owned company holds over 60% of the shares. This secures long-term sales channels but also brings certain political risks. Now let's take a look at my entry point. My entry price is €3. Currently, I have an unrealized loss of 30 cents. In total, I hold 35 shares. I've already received 88 cents in dividends. The dividend is paid here semi-annually. Now let's move on to the fundamental data and valuation figures. The 52-week high and low range between €2 and €4, currently at around €2.97. Based on 13 available models, Investing calculates a price of €4.09 here. That would correspond to an upside potential of 37.4%. Let's take a look at the numbers, and they are impressive. Revenue in 2024 was $4.1 billion. EBITDA was $1.35 billion. We have a net profit of around €726 million. We have a net profit of around €726 million. We have an equity ratio of over 70%. The net debt is practically zero. Yancoal holds more cash than debt. The free cash flow in 2024, €58 million. That results in an EV over EBITDA of 2.8. So, extremely cheap compared to competitors like Whitehaven or New Hope, some of which are trading at more than double. That is, at twice that level. The price-earnings ratio is around 7.1. The sector median is over 10. According to internal valuation models from InvestingPro, the fair value is €4.09 or converted 9.6 Australian dollars. Now let's move on to cash flow and dividend policy. Yancoal is a prime example of strong cash flow. In the last 3 years, the company has paid out a cumulative total of over €3 billion in dividends while simultaneously reducing its debt. The current dividend yield is 11% with a payout ratio of 71%, so it's still in a healthy range. Let's take a look at the history. In 2022, the dividend yield was 82 cents. In 2023, it was 64 cents, and in 2024, despite weaker coal prices, it was 20 cents. These fluctuations clearly show Yancoal is a cyclical company, but also extremely shareholder-friendly. When the coal price rises, the money flows to the shareholders. Now let's move on to the balance sheet quality and stability. The balance sheet is remarkably strong. At the end of 2024, total assets stood at €7.38 billion, equity at €5.56 billion, and total debt at €1.82 billion, of which only €67 million were long-term. This means there is no net debt. To put that into perspective, Yancoal could theoretically settle all its outstanding debts immediately and would still have over €1.4 billion in cash remaining in its bank accounts. This essentially means the company is exceptionally well positioned and prepared for potential increases in interest rates and economic recessions. In addition, a detailed analysis of the company's cash flow clearly shows All annual interest payments are comfortably covered more than 30 times over by the total operating cash flows. Here we currently see a brief competitor analysis. Here is Yancoal Australia, also classified as undervalued, and here are its competitors. Let's move on to growth and forecasts. What do analysts expect between 2025 and 2029? They forecast the following. I think I'll show you this list in a moment, but I'll briefly explain it again anyway. In 2025, revenue is expected to be at 3.3 billion. EBITDA at 875 million, so EBITDA at 875 million. An EPS of 25 cents and a forward PE ratio of 8.3. As I said, I'll show you the table in a moment, but for 2028, analysts expect an EPS of 41 cents per share and revenue of 3.75 billion euros, EBITDA of 1,046 million euros, and a forward PE ratio of 6.9. Just so you've already heard the numbers for 2025 and also for 2029. You can see that after a decline in revenue in 2024, the numbers stabilize again from 2026 onward. This happens in parallel with the expected commodity supercycle, which is essentially my thesis. Many mining analysts assume that global coal demand will not decrease significantly by 2030, especially not in Asia. Now, let's look at the valuation compared to the industry. In the peer comparison, Yancoal performs strongly. I just need to quickly look at my table to see what I've summarized. I've divided it into company, dividend, EV, EBITDA, PE ratio, and upside according to DCF models. Here with Yancoal, we have an 11% dividend, an EV/EBITDA of 2.8, a PE ratio of 7.1, and an upside according to DCF of plus 88. With Whitehaven, the dividend is around 2% as we calculated. An EV/EBITDA of 4.2, a PE ratio of 9.4, and an upside according to DCF of plus 32. Then New Hope, dividend at 7%, EV/EBITDA of 4.5, a PE ratio of 10.1, and an upside according to DCF of plus 25. Now in comparison to Tongchila. Here we have a dividend of 15%, an EV/EBITDA of 2.6, a PE ratio of 5.8, and an upside according to DCF of plus 75. So Yancoal is clearly in the attractive valuation segment, cheaper than Whitehaven or New Hope, but with more stable cash flows than many South African producers. Now let's take a look at the opportunities and risks. The opportunities: we have high cash flow at a low valuation. We have enormous dividend potential. We have strategic buyers in Asia. We have a possible re-rally in coal prices in the wake of geopolitical tensions. The risks: we have a strong dependence on coal prices. We face political pressure in Australia and ESG issues. We have a majority owner in China who could exert influence, and we have the currency risk of the Australian dollar versus the euro. But this is exactly where the opportunity lies. Many institutional investors avoid fossil fuels. This artificially depresses the valuation. In the long term, these stocks could become the best cash flow machines of the decade. Now let's take a look at the technical analysis and the chart pattern. Technically, Yancoal is moving between €2.50 and €3.85. The 200-day moving average is around €3.10. So the stock is trading slightly below the fair range with clear support at €2.50. In the long term, since 2021, we've seen a sideways trend with recurring dividend peaks. A breakout above €3.90 could pave the way to prices above €5, which is almost exactly the fair value according to the DCF model. At €5, we would be moving from here roughly to here. That would mean almost 70% upside, or in extreme cases, maybe even up to €12. I conduct all my fundamental analyses using InvestingPro. You can find my affiliate link with a 15% discount in the video description as well as in the pinned comment. Now let's move on to the conclusion and my personal assessment. For me, Yancoal Australia is clearly a cash flow machine. Inexpensive, solid, with a double-digit dividend yield and a clean balance sheet. Anyone who can withstand the cyclical fluctuations and is committed to energy and commodity stocks for the long term will get a real dividend booster for their portfolio here. Especially in the context of the upcoming commodity supercycle from 2026 to 2028, Yancoal could benefit massively both through rising profits and high payouts. This is not investment advice, but for me, it's clearly a high-yield value play with considerable catch-up potential. So now the proof that I don't just talk, but actually take action. For me, as I just saw, Yancoal has currently dropped below my entry price, and based on all the analyses we've just done, I would simply like to increase my position accordingly right here. Let's just go ahead and do that together. As you can see here, it's also more or less at its low point. Since I'm already well invested in coal, I'll increase my position here from 100 euros to a total of 266 euros. So now you have clear proof. I stand behind what I represent here on my channel. Now you also have clear proof here that I actually put into practice what I discuss or analyze with you. All the stocks I present, I actually have in my own portfolio. And as you can see here, I don't just talk about it, I actually put it into action. If you enjoyed this video, please leave a like and subscribe so you don't miss any part of the mining series from MB Capital Strategies. In the next video, we'll take a look at the next mining stocks, and at the end we'll compare all the mining stocks just like I did with the pipeline comparison. But here I'll probably make a bit of a distinction between coal stocks, silver stocks and gold stocks, because if I just lump everything together, it doesn't make sense since they're different sector classes. Exactly. Otherwise, feel free to discuss and leave comments about whether you like the video, or also comment on which mining stocks you currently have your eye on or have recently bought, and how you view the whole mining and energy sector. Do you also think that a commodity supercycle is likely in 2026, or do you see it differently? I'm always open to different opinions and welcome all viewpoints. Just write it in the comments. Until then, I wish you successful investing. See you in the next video.